Thank you for tuning in to another episode of Retire Right. I am Ryan Wyatt, per usual joined by Ron Wyatt and Nick Lewandowski. All three of us are wealth advisors here at the firm. Ron and Nick work together on the investment committee. We are recording this episode during the week of Thanksgiving. I know Ron and I are going to go see some family, just kind of jumping around different parts of Pennsylvania to do that. Nick, any fun plans for Thanksgiving with your family?
So my in-laws are hosting this year.
Nice.
They are local to here, so it makes it easy. But we may need a second turkey just for my daughter this year. So she's 15 months. She's walking everywhere now, and there must be a growth spurt happening or something because all she does is eat the last few days.
Yeah.
Like, cost of living is going through the roof on this trend in our house.
Well, I guess it's good that the appetite's there, but
I guess it's better than the other problem,
Yeah,
but
right.
Man, she can really put it away for a little gal.
The topic that we're focusing on today is a market outlook. It's the fourth quarter here, 2025. We thought it would be relevant to do that. We're actually going to start doing this every quarter, just kind of giving quarterly updates on the markets. So we always look backwards, talk about what's been happening in the markets, talk about current day, what's happening today, and then we take that information to give an outlook for the future. Not predicting what the markets are doing, just making sense of the information and what that typically means for future outlook / performance. So with that said, Nick, can you paint the picture for us? What's been happening in the markets over the past 10 years or so, and then kind of today?
The last 10 years has really been a story of U.S. dominance in terms of returns. And even within the U.S. market, it's really the largest subset of U.S. stocks. And even within that subset of stocks, it's really the largest technology-related stocks. You hear this term thrown around, the Magnificent Seven.
Right.
These seven really dominant, big U.S. tech companies is what that refers to. And the returns on those stocks have been outstanding over the past 10 years, to the point where, understandably, people look at the past and they say, well, I'll just put all my money in these.
Right.
What do I need to go elsewhere in the world or elsewhere in the U.S. market for? And our answer to that is, we think, based on what we look at and the data that's out there today, there's good reason to believe that the next 10 years are unlikely to look like the last 10 years have looked. That's my little teaser for our topic.
And I just wanted to throw something in. So I read recently that if you look at the worth of each market, the U.S. market, the Chinese market, NVIDIA, the stock, would be third ranked. It'd be United States, China, and then NVIDIA is worth more than any other market around the world. I think it still holds true, but I know, not too long ago it was definitely the case.
So, Ron, can you take us a step further, look underneath the hood and tell us, from like the valuation standpoint, what's happening in the markets and what you're noticing?
Sure. I'm going to show you a table in a minute, but what ideally should happen is that fundamentals are things like earnings and cash flows and revenues, right? And those should go up, and the stock price should kind of go up in a similar manner.
Sure.
If the stock prices go up a lot more than the fundamentals, that means the market is getting expensive. Okay. And that's what I'm going to show you now. So in the table, on the left-hand side, we have the S&P 500, and then four other segments of the global market. We have U.S. mid-sized companies, U.S. small companies, and then we have developed, excluding the United States. That'd be like Germany, Japan, United Kingdom, and the emerging markets like Mexico, India, China. Okay. And so I have a bunch of different measures. And all these measures, you're looking at what you're paying, the price, compared to what you're getting. So it might be earnings, revenues, cash flows, the dividend yield. And so what's interesting is if you compare the S&P 500, those 500 large U.S. companies, compared to the average of those four segments of the market, you're paying about 85% more on average for the U.S. large companies than those other four.
So what you're saying is the market's expensive right now.
Especially U.S. large companies.
Okay.
Yes.
So how, like where we're at today, how does that stack up to other periods in time in terms of how expensive the market is?
So that's a great question. So two things. We are the second most expensive market ever. The .com was the first.
Okay.
Now, there's two other times the market appeared expensive, but that's not because prices were up. Prices were actually down. It's because earnings collapsed, like, for example, in the global financial crisis.
Okay. So just if you could just explain that a little bit further. I know what you're talking about, and the concept is similar to one of the concepts we discussed in a previous episode, which was the dividend trap episode. Right. So what you're saying is that the market looked expensive, let's say during like the global financial crisis, but that's really just because one number in a metrics lowered, so it kind of skewed the results.
Exactly.
So could you just explain that a little bit more?
So the prices during the global financial crisis went down over 50%, but the earnings went for temporarily to near zero. And so when you do the division, if the denominator is a very, very small number, it makes the...
right, so it's skewed the numbers. It's not
right.
a true representation.
Right, it's not true representation.
Okay.
Now, I'm just looking at normal markets that, with normal types of earnings, and again, we're the second most, going back to 1871.
Okay. Now, obviously, the other thing that comes to mind, too, if you focus on like the Magnificent Seven, as an example, we're talking about the S&P 500, just the way that the S&P 500 index works, when companies within that index, when their valuation starts to go up, they start to take on a larger share of that index.
That's correct, yes.
So can you speak to the level of like concentration risk that there is in the current environment as well?
Yeah, the S&P 500 is extremely concentrated. Nick mentioned the Magnificent Seven. Mm-hmm. Okay, those 7 stocks represent about 35% of the S&P. So think of it this way: if you invest $100 in the S&P 500, $35 is going into 7 stocks. It is the most concentrated that we've ever been, even more concentrated than the .com bubble.
And that obviously has risks in itself.
Sure.
Okay, so now you start to get into you might think that you're more diversified than you really are.
Exactly.
Okay.
It's it ends up being very concentrated.
So if something happens where, like you said earlier, the earnings and the valuations should track pretty close to each other, right?
Yes.
When there's a mismatch there, that's when risks of, let's say, the market correcting itself kind of pick up. And if you have less diversification because you're overly concentrated in these 7 stocks, you could feel that decline or that correction a lot more than somebody that's diversified.
Or, either maybe a correction or future returns become less, either way.
Sure. Okay. So is valuation, the most important thing, or like the only thing that matters?
Well, there's 2 other things that matter, and I'm just going to really focus on one right now. But the other one is profitability, and what the U.S. market should be more expensive than the other markets because we're more profitable, especially like U.S. large companies. But the one I really want to focus on is earnings growth. And what you can see on the far right of the table is that over the next 3 to 5 years, the S&P 500 earnings are expected to grow about 12.5% a year. Mm-hmm. Now, I don't think it's going to be that much because analysts paint too rosy of a picture oftentimes, right. But it's relative. And if you look at the other 4 segments of the market, you see that on average, the growth rates expected in those 4 areas probably are about the same. And so now you're paying 85% more in price, and you're really not getting any more expected earnings growth.
So is the simple takeaway that a lot of these Magnificent Seven companies, they're making up a large portion of the market right now, and they're expensive?
Exactly.
So if they are expensive, is there anything surprising happening? Like, are they still kind of meeting their earnings estimates? Anything worth mentioning there?
The fundamentals have been extremely strong. So fundamentally, that they're great companies. You just have to wonder, am I paying a fair price for them?
Okay, gotcha. Now, what does all of this mean for future returns?
So what studies show is that the price you pay today has a major impact on 10-year expected returns. Not 3 months, 1 year, but on longer term expected returns.
On that note, how do you estimate, future returns? And if it's not too technical, could you talk about doing that for stocks and for bonds?
Sure. Let's focus on bonds first. So that's easier. So bonds, you take the current yield. Mm-hmm. You take default risk. Like if it's a high yield bond, some of them may default, so that'll decrease return. And you have to look at if interest rates change, how does that impact the return? Okay.
Right. Okay.
So that's real straightforward. The stocks, a little bit more. You take something called the earnings yield. That's the opposite of the PE ratio. It's similar to a dividend yield. And what you want to do is you want to add the expected growth rate. You want to add the dividend. And what you want to do is, if the market's very expensive, you assume that the market becomes more reasonably valued, so that would subtract return. But if the market's really inexpensive, you expect, again, regression to the mean so that the market gets to be more of a normal value, which would add to the expected return.
Okay.
Hopefully, was that clear enough?
Yeah.
Okay, good.
So could you cover, I know we've been talking about the S&P 500 so far. Could you talk about some of the expected returns going forward for S&P 500, but also different areas of the market as well?
Absolutely. So let's first of all start with stocks. So on the table, you see on the far left different market segments, again, around the world. Mm-hmm. You see large, but this time I included U.S. large value. Those are the stocks that are fundamentally cheap, small, developed ex-U.S. and emerging markets. And I'm using 4 different sources: Vanguard, J.P. Morgan, BlackRock, and RAFI stands for Research Affiliates. Mm-hmm. And some of them say they're long-term expected returns, some say 10 years, but they're very, very similar. And so I simply just took the average of the 4 and show it in the far right column where it says average, right?
Okay.
So U.S. large companies are expected to return on average about 4.7%, which is way lower than the historical norm, which has been around 10%. And what I want you to notice is that all the other markets that I've listed here have higher expected returns than U.S. large stocks, especially U.S. value, that's cheaper stocks, and developed ex-U.S. That's, again, examples like Germany, United Kingdom, and Japan.
Okay.
And the reason being is, as I showed on the previous slide, they're cheaper, and the expected growths are very similar.
Okay. And so that's for the equity markets. What about bond?
So we're showing, first of all, inflation. The average is expected around 2.4%. Cash returns historically have been very similar to inflation. The 4 sources are thinking cash returns average around 3.5%. And then you can look at the different types of bond markets. You can get intermediate term treasuries. Those are kind of like 5-10-year treasuries. Longer term tends to be, definitely over 10, and a lot of people would say over 20. And where it says U.S. credit / investment grade, those are really just corporate bonds. And private credit is bonds from companies that are not publicly traded. They're private, okay? And you can see the returns for the different types of bonds really range between 4 and 5%, except for the private credit, somewhere around 9%. And I actually think that 9% seems a little bit aggressive. I would be more comfortable with maybe in that 8.5% range.
Okay, so I know what we're doing on the, in our bond portfolios is a little bit different. So if you look at the kind of the expected or the expected returns going forward, what would you say the expected return for our bond portfolios looks like?
So our bond portfolio uses intermediate treasuries, long treasuries, floating rate treasuries, which are not listed, and then private credit. And the yield's about, right now, close to 5.85%, the yield to maturity, which is really interesting. If you compare that to the equity markets, very similar to most equity markets. So, some years ago, yields were very, very low. Treasuries, 10-year treasuries dipped below 1%. Now, a bond portfolio appropriately structured, without too much risk, can get almost equity-like returns with a lot less risk.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So if the expected returns going forward for the markets, at least, let's say large U.S. stocks are lower than expected return for our bond portfolio or similar to certain areas of the bond market, what does that mean for, people that are nearing retirement or recently retired or in retirement and have that balanced portfolio?
So a couple things. I'm not telling people to sell U.S. large companies, okay? I just want to make sure there's diversified portfolios and they have stick with a program. But it really means that in the financial plan, make sure you're using reasonable conservative numbers and you're not expecting stocks to do over the next 10 years, 10, 12%. Recently, they've been way over that. I just don't think that will continue, like Nick said earlier.
So if anything, this puts an emphasis on diversification.
Yes.
Potentially changing, the weighting of certain asset classes or, the weight that you have in certain areas of the market, but it doesn't mean that you are sitting here and strategically getting rid of all of those positions to go to better expected return.
Absolutely not. Our portfolio is not changing because we have it set up appropriately already.
Gotcha. Okay.
But if you're an investor doing it on your own and you're focusing on U.S. large caps, as Nick said earlier, the recent past may not, the future may not look like the recent past.
And we see prospective client portfolios. It's very common for people to come in and we do a portfolio review, and they're heavily oriented toward U.S. and U.S. large cap stocks. Like 85-90% of the portfolio is concentrated in that one market segment. So we're not saying go to zero, but maybe
diversify
some lower percentage than 85 or 90% in U.S. large caps.
So, Nick, to that point, do you think that people are thinking about this? If they're thinking about it, but they're not using the information to kind of like course correct or better diversify the portfolio? Are they just complacent or are happy with the current returns and kind of ignoring the risk? Do you have any thoughts on that?
I'm going to answer from the perspective of looking at folks who are thinking, like some people don't think about anything at all, right? That's a separate issue. I'm talking about people who are thinking about this and kind of knowingly just want to be in U.S. large cap stocks. And I think everything in investing is behavioral at the end of the day because people choose like buy, sell, how to allocate capital. And what happens is there's a strong pronounced tendency for all of us to drive in the rear view mirror to an extent where, you look at what's happened in the relatively recent past and you have a bunch of data about the relative recent past and it feels good to just assume that's going to continue for the foreseeable future. So in this case, those stocks have done really well for the last, 10 years. Like they're obviously going to continue to do well going forward. And that's what people fall into believing. But ultimately, because of that, they end up being overly optimistic of what will happen in the future. They forget the fact that when prices get really high, like all that stuff about valuation that talked about, we're almost talking about future, about previously in the episode about valuations, what it means for the future is that when prices are really high like that, a lot of good stuff is already in the price. You're paying for what you're getting today, plus a bunch of good stuff in the future when a stock is really, really expensive. So that behavioral piece, I think, is really what drives what I would go so far as to say complacency in some of these areas. Yeah.
So how would you summarize, like what that really means, and for the people listening to this video, how they should be thinking about, their portfolios or their portfolio management for a retirement portfolio going forward based on the information?
So number one thing, don't just chase what worked for the last decade. It's tempting after a big run in like an NVIDIA to want to push all your chips in that direction. And it's well documented that when you kind of chase stuff like that, your results don't end up being very good over time. We've done other episodes where we've touched on this topic before. That's the number one thing I'd say. The number two thing I would say is you got to stay diversified. And we talked about this in this podcast episode in a couple different ways. We talked about it in a global sense, where Ron was talking about how stocks outside the U.S. actually have pretty attractive returns right now, whether it's developed or emerging markets, attractive expected returns over the next 10 years. But even within the U.S. market, if you focus on what we call value stocks, which is those stocks that are cheaper relative to those fundamentals that we spent so much time talking about earlier, they're still pretty attractive, even if the overall U.S. market is a little expensive. So that diversification component is huge. Subset to that, you want to build your portfolio always really around durable long-term return drivers. And the two that we focus the most on are valuation, which we've obviously like really flogged that horse on this episode, and profitability. Those are two great anchors for a portfolio. And the last one is just kind of this general overarching advice that matters for everyone we talk to. The risk and the structure of your portfolio needs to align with your specific goals, not what the headlines say, not what the talking heads say about what you have to own that's going to be the best lottery ticket, to buy right now. Whatever you're doing in the portfolio, you have to bring it back to your circumstances and your plan, and that may or may not align with what the talking points in the media or if the cocktail parties really are.
So, that all makes sense. I don't know that, somebody is going to just hear that and say, okay, yeah, that's logical. I might be doing the wrong thing in my portfolio. Sometimes what happens when you have these high flying companies that are giving such great returns, it becomes very difficult for investors to focus on logic.
Sure, academic. I'm going to go get rich in my growth stocks.
They're going to, their behavioral finance suggests that they might still stay with the strategy, even if deep down they know it's not there. So can you guys talk about, like, if you keep pursuing that path, investing in U.S. large stocks, the Magnificent Seven, chasing that, even maybe you haven't been invested in them up until now, but you're just tuning into the news and hearing about these companies, and now you're starting to purchase them at their all-time highs. Like, what are the real risks of doing that? And have you guys seen this in the markets before? And does it always play out well for these people that are kind of adopting that, not so logical strategy?
Right. So I don't want to focus just like on Magnificent Seven. I want to look at a longer term history at like the super mega caps. The Magnificent Seven, again, are very good companies, somewhat expensive. But the risk really tends to be two things. One is just like an opportunity cost. When you pay a lot compared to the fundamentals, the returns tend to be lower going forward. It's that simple. And the second thing is, if there's a correction, sometimes the high flyers get hit more. Either way, it tends to be lower expected returns going forward. It's that simple.
Okay.
And I'll comment that from maybe a slightly different angle that is a bit longer term, but along the behavioral lines that I was talking about before, which is that, I've seen over my career over time with people in the markets that are doing this chasing thing is, they look at what's hot, they pile in at the highest price, worst forward-looking return time. Then they get frustrated because either the prices go way down or they're just frustrated because they're not going anywhere. They sell those. They move on to the next big thing, and we did an episode on this cycle of you're buying high and selling low, and it's just a wealth destroyer over time, right? Because you're paying really high prices and then you're getting out at lower prices, and I think setting up that cycle by doing this and by only wanting to be in the stuff that's worked really well over recent years is in my opinion like the most dangerous long-term behavior pattern you set up.
And I think this is like a really good way of bringing the point home. By no means am I suggesting that this happens, but I saw something this weekend actually about Cisco, and I know we've actually mentioned Cisco in past episodes, but this is kind of like the risk that you face. So if you look at Cisco before the tech bubble, this is like all the way back in 2000, their price was around $77. It was like the kind of the peak that it reached. It still today has not got back to its pre-tech bubble price. Now it's close. It's at like $76 and roughly 50 cents, but still hasn't reached the $77, and that's 25 years later.
Yeah, and to be fair, if Cisco was trading at like 140 times earnings.
Right.
So it took a long 25 years for earnings to catch up to the price.
But
right?
that's the point. Like that's some of the risk that you take when the valuations and the earnings are mismatched.
Right.
And our strategy focuses on reducing that risk as much as possible by actually looking under the hood and looking at like what is a realistic or a fair valuation.
Right. And I did want to make another comment about Magnificent Seven. We're not super negative on it. It's just that we don't want people just to focus just on it.
Right.
The Magnificent Seven, the quality of the companies today compared to the .com are better, and the valuations are high, but they're not near as high as they were. Okay. And like in our stock rating system, a lot of the companies like Meta, Alphabet, Microsoft, Apple, they're kind of ranked in that. If 100's good and 0 bad, kind of that 60 range. So they're not horrible. They're just not incredibly good. So it's a matter of it's okay to own them, but just don't go overboard.
Right, exactly. Retirement investing is not about hitting, grand slams and always looking for that next, grand slam. It's about getting, it's like if you've ever watched the movie Moneyball, it's like consistently getting base hits.
Singles, you get some doubles,
and just
triples,
like
and now and then you get a home run, but
methodical,
exactly.
disciplined, and hopefully your investment process. It's not just own the market, whatever the market does. It's a step further than that, and over long periods of time, you might get an excess return over the market. But it's not about, like I said, those consistent grand slams because that's just there's so much risk involved in that, and who knows if you're going to consistently be right. So. We hope that you guys found this, our listeners found this episode informative. Please like and subscribe to the show. We put new episodes out every 3 weeks. Please don't hesitate to comment with future episode ideas or even email us in with future episode ideas. And then per usual, if you think somebody would benefit from listening to this, feel free to spread the word and share the episode. We hope you guys enjoyed. Thank you.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.